Insurance was never meant to protect you. It was created to make money when things go wrong. Centuries ago, a small group of people figured out how to profit from disaster without sailing ships, building factories, or fighting wars. That single idea didn't just change money, it built modern capitalism. And once you see it, you'll never look at insurance the same way again. In the early days of global trade, money didn't move through apps or banks. It moved on wooden ships. If a ship survived the journey, the merchant became rich. If it didn't, everything was gone. The cargo, the investment, sometimes the people too. This made trade terrifying. One storm could erase a lifetime of work. So when someone offered protection, it felt like salvation. Pay a small fee, they said. If a ship sinks, we cover the loss. To merchants, this sounded fair. Smart even. Why risk everything when you could share the danger? This is the first lie everyone believed. They thought insurance removed risk. It didn't. It only rearranged who suffered from it. The merchants still depended on the voyage. The sailors still faced death at sea. The colonies still burned and collapsed. But the insurer? They didn't sail. They didn't fight storms. They didn't touch the cargo. They sat safely on land, collecting payments from hundreds of merchants at once. Here's what most people missed. Insurance wasn't built to save the unlucky. It was built to profit from statistics. If one ship sank, 10 others would make it back. Losses were rare. Premiums were constant. The math always favored the seller. And slowly, something dangerous happened. Merchants stopped caring if the ship survived. They cared if the odds made sense. Risk stopped being a threat. It became a business model. This changed human behavior. Traders sent ships through more dangerous routes. They packed vessels heavier. They pushed sailors harder. Why? Because the downside was capped and the upside was unlimited. This is where the system revealed its true nature. Insurance didn't make trade safer. It made risk cheaper. And when risk becomes cheap, people take more of it. The public believed insurance was protection, but behind the scenes it was a filter. Those who could afford premiums got to play the game. Those who couldn't were exposed to ruin. Over time, wealth stopped flowing to the careful. It flowed to those who could manage perception, probability, and paperwork. The lie wasn't that insurance worked. The lie was who it worked for. People thought insurance existed to soften disaster. In reality, it trained society to accept disaster as long as someone else priced it correctly. And that belief laid the foundation for everything that came next. Once insurance proved it could turn uncertainty into steady income, it stopped being a safety tool and became something much bigger, a system. In the late 1600s, global trade exploded. Europe wanted spices, silk, sugar, and silver. Ships crossed oceans non-stop. With more ships came more risk. And with more risk came more opportunity for those who knew how to price it. In London, merchants, ship owners, and financiers gathered in coffeehouses. These were not casual meetings. They were early financial hubs. News arrived daily: which ships sailed, which routes were dangerous, which ports were at war. One coffeehouse became famous for this, not because ships were launched there, but because decisions were made there. People began writing their names under shipping contracts. Each name meant something simple. I will cover part of the loss if this ship fails, in exchange for a fee. This was underwriting, and it changed everything. Instead of one person carrying all the risk, it was sliced into pieces and sold. One ship could be insured by dozens of people. No single loss could destroy them. Here's a key shift most people miss. Insurance stopped depending on trust and started depending on information. Those who had better data won. Weather patterns, war rumors, port conditions. This is where finance separated from labor. Sailors risked their lives without knowing the odds. Insurers calculated the odds without risking their lives. Slowly, the business evolved. Premiums were collected regularly, losses happened occasionally. The gap between the two became profit. And that profit didn't sit still. It was reinvested into more ships, more trade, more insurance. Money began creating more money without touching the real world. This is a critical moment in history. For the first time, wealth was no longer tied to production or ownership. It was tied to prediction. If you could predict risk better than others, you could grow rich while appearing invisible. This system rewarded calm, patience, and distance from danger. The closer you were to the risk, the less you earned. The further you were from it, the more control you had. By the early 1700s, insurance wasn't just protecting trade, it was shaping it. Routes were chosen based on premiums. Wars affected prices before they affected people. Entire economies moved based on risk calculations made in quiet rooms. What started as a promise of protection became a machine that transformed fear into fuel. And once that machine was running, capitalism had a new engine. Not factories, not workers, but a system that learned how to turn uncertainty itself into profit. On the surface, everyone seemed to benefit. Merchants expanded trade, empires grew richer, cities filled with goods from across the world. But if you look closer, the rewards were not shared equally. The people doing the most dangerous work earned the least. Sailors crossed unknown oceans for fixed wages. Dock workers handled cargo without knowing its value. Colonies produced wealth they would never see. And kings? They taxed what they could and fought wars they barely understood. The real winners didn't sail ships or rule nations. They sat in rooms with ledgers. Insurance allowed a small group of people to step outside the normal rules of risk. Everyone else faced uncertainty. They faced averages. This gave them a massive advantage. If a voyage failed, it was tragic but manageable. If it succeeded, the premium was pure gain. Multiply this by thousands of voyages over decades, and something new appeared. A class of people whose wealth grew steadily, quietly, and predictably. They didn't depend on harvests, battles, or discoveries. They depended on probability. And then they made a second move. They used insurance money to shape the future. Premiums didn't sit idle. They were invested into government debt, war financing, infrastructure. When nations needed money, insurers were ready. This created a powerful loop. Wars increased risk, risk increased premiums, premiums increased capital, capital funded more wars. No conspiracy, just incentives working perfectly. Here's the uncomfortable truth. Insurance didn't just react to history, it influenced it. Trade routes shifted based on pricing. Some colonies thrived while others were abandoned. Entire regions became too risky to matter. Decisions that looked economic were actually political, and they were made by people no one voted for. Over time, insurers gained something more valuable than money. They gained leverage. If they raised premiums, trade slowed. If they refused coverage, projects died. If they backed a government, confidence followed. This is how finance learned to rule without ruling. No crowns, no armies, just contracts. Capitalism didn't reward the strongest or the smartest. It rewarded those who could stand far enough away from danger to calculate it. The closer you were to real risk, the more replaceable you became. The further away, the more powerful you grew. By the time people realized who was winning, the system was already permanent. Insurance had done its job. It didn't just protect wealth. It quietly decided who was allowed to create it in the first place. The ships are gone. The coffee houses are quiet. But the system never left. It simply changed its shape. Today, insurance decides which homes get rebuilt after disasters, which businesses survive accidents, which risks are considered normal, and which are unacceptable. Nothing moves forward without coverage. That alone should tell you who holds power. Modern insurance doesn't just respond to the world, it filters it. If a project can't be insured, it doesn't exist. If a region is labeled risky, investment disappears. If premiums rise, prices follow. You feel it without noticing. In rent, in healthcare, in food prices, in travel. Every premium is a quiet tax on uncertainty. And just like centuries ago, the distance from risk still decides the reward. When disasters happen, individuals are told to be responsible. When systems fail, losses are spread across society. Insurance companies collect steadily in calm times. In crisis, they renegotiate, delay, or deny. This isn't corruption, it's design. The same logic that powered ships across oceans now powers modern capitalism. Risk is priced, loss is managed, profit is protected. And most people are taught to accept this as normal. Here's the deeper legacy. Insurance trained the world to believe that uncertainty is unavoidable but manageable, as long as someone else is paid to carry it. This mindset changed behavior. People take on more debt because it's insured. Corporations take bigger risks because losses are limited. Governments gamble because consequences can be delayed. The system rewards confidence, not caution, and it always has. The people closest to danger still pay the highest price. The people farthest from it still write the rules. That's the real inheritance of early insurance. Not protection, not safety. Control. Control over which risks matter, which losses count, and who absorbs the damage when things break. So when you pay a premium today, you're not just buying peace of mind. You're participating in a system built centuries ago to make disasters predictable and profit inevitable. Capitalism didn't grow because the world became safer. It grew because someone learned how to make uncertainty pay. And that bill, it's still coming due.